we've been looking at transactions for merchandising businesses, and we looked at the sale of merchandise. Now we're going to look at the purchase of merchandise and how they are recorded, okay? So the first thing, the line here, if we are to purchase merchandise, so a merchandising business such as Target or Walmart, they need to have merchandise on hand to sell. Okay, so when they purchase merchandise, they're going to debit merchandise inventory. So merchandise inventory is considered an asset account. And as we know, if we think about our T accounts, right, we know that asset accounts are increased on the debit side and decreased on the credit. Okay, so keep that in mind as we go through these transactions. So Net Solutions purchased $2,510 worth of inventory for cash. So that is simply going to be a debit to merchandise inventory and a credit to cash. Okay, now the other way that merchandise can be purchased is if it is purchased on account. Okay, so they're going to pay it back later. So for that, we have a purchase of $92.50 from Thomas Corporation. So that is going to be a debit to merchandise inventory and a credit to accounts payable. Okay, and then we indicate the account payable as Thomas Corporation. All right, because that is a liability that we will need to pay back. Now, just as a merchandising business will offer customers discounts, when a merchandising business purchases things, they are offered the same type of discount. Okay, when they purchase their merchandise for sale, they are offered the same types of discounts. So the buyer may receive a discount from the seller, and that's known as a sales discount, for early payment of the amount owned, which is going to be purchase discounts. Okay, so this is just like the sales one we looked at, but now we're thinking as the company. All right. This is going to reduce the cost of the merchandise purchased. So just like it reduced the cost of the merchandise sold, if you could think back to those transactions, this is going to reduce the value of the merchandise. So Net Solutions purchases inventory on March 12th in the amount of $3,000 with the terms 210 net 30. Okay, and we remember 210 means if you pay within 10 days, you get a 2% discount. Otherwise, pay within 30 days and you have to pay the full net amount. So when that purchase is made, it is written on the books as a debit to merchandise inventory and a credit to accounts payable. Okay? Now, let's say the company decides to take advantage of that discount and pay it early. What happens is they're going to debit accounts payable. That's going to be reversing this credit, okay? So that debit right here, this debit to accounts payable, reverses that credit, okay? But we're not paying them the full amount because we took advantage of the discount. We got a 2% discount, which is $60, okay? So we're only paying them $2,940. That's why cash is credited $2,940, and the remaining balance goes a credit to merchandise inventory. Okay? Because originally we recorded merchandise inventory of having a value of $3,000. That's not actually how much it's worth. Okay? Because we took a discount on it. So it's going to be $3,000 minus this $60 that we're crediting here. Okay, now if you don't take a discount, what happens when it's time to pay? All you do is accounts payable, a debit to accounts payable of $3,000 and a credit to cash. Nothing happens to merchandise inventory when it's time to pay if you're not taking a discount. Okay, it's only when you take a discount that you have to adjust the merchandise inventory account. All right. Purchase returns and allowances. Okay, so a buyer may receive an allowance. So you're thinking now as the company again, okay? So the company is the buyer. A buyer may receive an allowance for merchandise that is returned. It's a purchase return, or a price allowance if something is returned and you're getting like a credit. Okay? From a buyer's perspective, it is called purchase returns and allowances. So this is usually done in the form of a debit memo. Okay, so what's going to happen is a debit memo is going to be sent to the seller, and it's going to propose to them the amount that they want to debit their account payable, meaning the amount they want to take off the books, the amount they think they don't owe because either they're returning the merchandise or the merchandise is damaged and they want a credit for it, okay? And it will also state the reason. So here we have a debit memo, okay? And it's a little difficult to see, so if I zoom in a little bit, okay? So Net Solutions, remember that's the name of the company, okay, up here. They are sending this to Maxim Systems. That is somebody that they buy from, okay, the seller. And they're saying that they would like to debit the account, what we owe you, we're debiting your account in regards to invoice number 7291 because we returned the item. All right, and we returned the item because you sent us the wrong thing. Okay, so to then record this, it is a debit to accounts payable of $900 and then a credit to merchandise inventory because we're taking that inventory off of our books. We no longer have it, and we're also no longer liable for paying this creditor of Maxim Systems. Okay, so a buyer may return merchandise, which we saw, or be granted a price allowance before paying the invoice. Okay, so this is before the invoice has been paid. Okay, what's this going to look like? So on May 2nd, purchased $5,000 of merchandise on account from Delta Data Link terms 210 net 30. All right, so that's just a pretty straightforward recording, okay? It's going to be a debit to merchandise inventory and a credit to accounts payable. Nothing different there. Now, on May 4th, $3,000 of merchandise was returned. Okay, so we know to reverse that entry and return some of the merchandise, we're going to debit accounts payable and credit merchandise inventory. Now, let's watch what happens to the T account for this accounts payable. This is important. So here's our little T account, right? So we first had a credit there of $5,000 because that's what we owed. All right, and now we're going to debit it $3,000. And when we do that, we see we have a balance of only $2,000. Okay? So now it's time to pay, and we are going to pay this on May 12th. Now, when we pay on May 12th, that means we meet the terms of the 210. Okay? So, accounts payable is going to be debited $2,000. We're taking that $2,000 off the books. We don't owe it anymore. But we don't have to pay them that full amount. Okay? We only have to pay them $1,960 because we had a 2% discount in the form of $40 that you see here. Okay? And what this is showing, this part right here, that's just showing you the calculation of how we got there. Okay? So this is what happens if something is returned before it is paid. Okay? Now, the previous one that we looked at was if something is returned after it's been paid. Okay? All right, so we're going to talk about freight on board, and freight on board deals with shipping and who pays for the shipping. Sometimes you'll do some shopping for merchandise businesses and it says shipping's included, right? So just as we as the consumers from the merchandise business can get free shipping, sometimes the merchandise business themselves, when they're buying their stock, can get discounts on shipping or free shipping. All right. So when we talk about freight on board, you're going to see it abbreviated as FOB. Okay. And there's two different kinds. This is what we call shipping point. And on freight on board shipping point, the ownership of the merchandise passes to the buyer when the seller delivers the merchandise to the freight carrier. Okay, so the moment the seller takes the merchandise and brings it to the UPS store, it is now the buyer's responsibility and ownership. And in this situation, when we talk about FOB shipping point, the buyer pays the freight cost. Okay? So on June 10th, merchandise from Magna Data was purchased. Terms FOB shipping point. So that means we know we're buying this and it's our responsibility to pay for the shipping. Okay? So we just record it as normal. A debit to merchandise inventory, $900. A credit to accounts payable, $900. Okay? Then also on June 10th, we paid $50 for shipping. Okay? Shipping is part of our inventory. It's part of the merchandise inventory costs. So therefore, it's going to go to the merchandise inventory count as a debit. It's going to increase. Okay? Because that's basically how much money we've spent on our stock. And we need to know how much we've spent on our stock because now we need to know when we turn around to sell it, what we need to price it at so that we're making money. Okay? So that's why it's put into that same account. All right. So when that happens, we have another transaction that says merchandise inventory, $50, credit cash. Okay. So that's freight on board shipping point. What if it's freight on board destination? So in this case, the buyer does not take ownership of the product until it's physically in their hands. So that means it's the seller's responsibility to pay for it. Okay, so this is like when you get free shipping. So if you order from Amazon, right, and you're a Prime member, I do a lot of ordering from Amazon, as you can imagine, right? And they ship a lot of things to my house. I don't get ownership of that product until it's at my door. Okay, whereas if I order from Target and I'm not getting free shipping, okay, and I'm paying the shipping, I become the owner the minute it sets off out of their facilities. Okay, so when we talk freight on board destination, June 15th, sold merchandise to Cran's Company on account, $700, terms FOB. The cost of the merchandise sold is $480. Now, when we're looking at this transaction, we're looking as the seller of merchandise, okay? We're not the buyer, all right? In the previous transaction, we were the buyer of the merchandise. In this transaction, we're the seller, okay? Because when we're buying merchandise and the seller of it is incurring the cost of shipping, it doesn't matter, okay? We don't care. So them selling us merchandise where they're picking up the cost, it doesn't affect our books in any way, okay? But when we sell merchandise and we're picking up the cost, it does affect our books, okay? So when we make this sale, if you think about the sales transactions, okay? So we're going to pivot a little bit from the purchase transactions back to sales, okay? To record this in the books, we're going to say June 15th, accounts receivable, $700, sales, $700, okay? We know that for every sale we make, we also need to adjust, and in addition to recording the sale, how much money we made, right? We also need to record the cost to us and adjust our merchandise inventory account, okay? So cost of merchandise sold is $480. And the merchandise inventory is $480. All right, so that means our merchandise inventory account has been decreased in value by $480. Okay, now on the 15th, we're also going to record the freight of this. Okay, and that's going to fall into a category called delivery expense. And just like all of our expense accounts, if you think about the T chart, okay, it's going to be an increase on the debit and a decrease on the credit, okay? So it's going to be a debit to delivery expense for $40 and then a credit to cash. Okay, so that is freight on board destination. Okay, now this is freight on board shipping point prepaid. Okay, so if you look back up and remember when we talk about shipping, right, shipping point, we're going to pay the cost as the buyer. Okay, so in this situation, we are selling merchandise. We are making the buyer of our merchandise pay for the shipping, but we're going to pay it up front for them. They are then going to be responsible to pay it back to us. Okay? So we're still thinking in sales. We are not picking up the cost of the shipping. The buyer is picking up the cost of the shipping, but we are paying it up front for them. So we sold merchandise to Planter Company on account $800, terms FOB shipping point. Net Solutions paid freight of $45, which was added to the invoice. The cost of the merchandise sold is $360. So there are 3 transactions. The first is just the regular sale, okay? So we have a debit to accounts receivable, Planter Company, $800, and a credit to sales, $800, okay? We're selling a merchandise on account. They're responsible for paying us. Sales is our revenue. We then also need to record the cost, the actual cost of the merchandise. Yes, we sold it for $800, but what did it cost us? And that is the second transaction you see here. Cost of merchandise sold, $360 is our debit, and we have a credit to merchandise inventory of $360. This last piece where we paid the freight for them, but it was added to their invoice, okay? This is going to look different than any other accounts receivable transaction we have ever done, okay? Normally when we do accounts receivable, if we are debiting it, we would never normally credit cash because really we use accounts receivable as another form of payment, okay? So if they're not paying us in cash, they're paying us in accounts receivable. This is unique, okay? Because we're paying it out of our pocket, but somebody owes us that money. Okay, and that's why we're going to see this as a debit to accounts receivable and a credit to cash. Okay, our receivables went up, but our cash went down because we paid it for them. All right, you've never seen a transaction do that. We've never seen an accounts receivable and a cash together like that. You have seen a debit to cash and a credit to accounts receivable, but we've never seen it this way. So that's very important to take a moment and think about and look at. All right, and the last thing is sales tax. Okay, so almost all sales levy a tax on sales of merchandise, right? In the state of New Jersey, it's 7%. The liability for the sales tax is incurred when the sale is made. Okay, so at the time of the sale, sales tax is collected, but then it needs to be put into a separate account that we will later pay to the state, okay? And you don't pay to the state, every time you make a sale. You basically do it once a month or so, all right? So when a sale is made on account, the seller charges the tax to the buyer by debiting accounts receivable, because even though we don't get to keep the money, we are still responsible for collecting the money, okay? So if we had a sale of $106 and 6 of it was sales tax, okay, that would be a debit to accounts receivable for 106 and a credit to sales for 100. And then we see this new account, and this is our sales tax payable account. And just like any liability account, right, sales tax payable, it's going to be decreased on the debit side and increased on the credit side, okay? It's a liability. We have to pay it off. Now, on a regular basis, we make that payment. So when you make the payment of the sales tax, you're going to reverse it by debiting sales tax payable and crediting cash. Okay, now in this example here, it's for $2,900. That's for, a large amount of sales tax, including the $6 that we previously recorded. Okay, so those are our transactions for purchasing. Freight on board. Remember, when you're looking at that freight on board, you got to be able to switch back and forth. Okay, whether you're the seller and it's a freight on board, or you're the buyer and it's freight on board, it looks different. Okay, remember what I talked about with that, and then also how to record sales tax.